Hi, my name is Matt Kakuda. I'm a financial strategist and a retirement expert. I've been in the financial service industry for about 6 years following my time as a sergeant in the United States Army. Today, I own and operate multiple six and seven figure organizations. So, welcome and thank you for watching. I appreciate your time and I promise that I'll be brief, but I'm confident that you'll find valuable insight in this video. Today, we'll address the financial turmoils many Americans are facing in the current economic climate. With rising inflation and ongoing economic uncertainty, countless individuals and families are struggling with significant financial challenges. According to recent data, nearly 60% of Americans are living paycheck to paycheck, struggling to manage their daily expenses and save for their future. The average American household debt has surged to unprecedented levels, with student loans, credit card debt, and mortgage piling up, leaving many feeling trapped and overwhelmed. Additionally, retirement savings are alarmingly low, with a substantial portion of the population nearing retirement age with insufficient funds to secure a comfortable future for themselves and their loved ones. These troubling realities underscore the critical need for effective financial strategy and support. In the coming segments, I'll introduce you to practical solutions and actionable steps designed to help navigate these financial challenges. From enhancing your financial literacy to strategic planning and investment opportunities, we'll explore how to turn these issues into opportunities for financial stability and growth. So, stay tuned to discover how you can take control of your financial future and achieve the security you deserve. So, I decided to start a business and I tried my hand at day trading. And despite my success in day trading, I missed the camaraderie I had during my time in service. That's when I met my business partners, the Walkers. And after a couple of hours, we quickly became friends. And they introduced me to our parent company. We then strategized on how to best leverage this opportunity and decided to collaborate, combining their extensive sales skills and my management and structural expertise. Within 8 months, we were able to open up our first brick and mortar location. Shortly after that, we surpassed six figures and then seven figures and established two remarkable organizations known as New Modern Wealth and the one I'm representing today, Motivated and Intentional Movement, or commonly known as MIM. At MIM, we don't just sell life insurance, we specialize in an asymmetric approach to finances. Our goal is to ensure that you have the tools you need to achieve lifelong financial security, whether it's creating a legacy plan for your kids, leveraging an account for business, helping families avoid probate so that way they can pass down more of their wealth, or even securing the most affordable life insurance and or even establishing a pension plan that you control and that you cannot outlive, which means income for life. Whatever your financial needs are, we're here to help. We also offer complex strategies like becoming your own bank and creating generational wealth that lasts beyond just the typical t-shirt to t-shirt cycle. There are two types of Americans when it comes to finances: those that make over $250,000 and those that make under $250,000. Many individuals earning under $250,000 are hardworking individuals, and their priority is often paying bills and hopefully saving a little. Many of these individuals are renters, and by the time they retire, they're relying heavily on the 401k and Social Security. While having some savings is better than nothing, there are way better retirement options out there for you. When it comes to retirement planning, it's crucial to understand that it's a four-phase process, which is contribution, accumulation, distribution, and the most important one, transfer. One of the most common retirement accounts out there is the 401k. So knowing how it works is important. And if you don't know how it works, or even what a 401k is, or even how to strategize, I encourage you to watch our video about 401ks on our channel. Since 401ks are tied directly to the market, they experience both highs and lows. And depending on the phase of your retirement, this can be either beneficial to you or extremely problematic. Personally, I don't enjoy losing money. Regarding Social Security, the trustees have stated the fund may be depleted by 2035, potentially making the account insolvent unless major legislative change happens. Now, let's look at individuals making over $250,000. They typically invest in brokerage accounts like stocks, mutual funds, crypto, things along those lines, in addition to life insurance. These individuals generally own property, and by the time they're 50, they are often financially free. My goal and our goal here at MIM is to help all Americans achieve what the top 5% do. And that's take control of your retirement and finances before it's too late. I can't stress the importance of what ownership is and should be to everybody. So let's explore the three primary places people like to put their money in. I like to call these my three homes of money. The first home is fixed, commonly known as the bank. And one of the benefits of a bank is that it's safe and it's accessible. But the downside to it is that it offers little to no growth and often comes with fees. To understand what makes a good account, consider the rule of 72. Now, what is the rule of 72? Well, the rule of 72 was invented by Albert Einstein, and he considered compound interest to be the eighth wonder of the world. And it's a simple calculation that basically tells you how long it's going to take your $1 to double in any given account. So let's just say, for example, we have a bank giving us 0.03%. You take 72 divided by 0.03%, which is your annual percentage yield or your APY, and you'll get 2,400. That just means it'll take 2,400 years for your $1 to become two in that given account. Now, I don't know about you guys, but I don't have 2,400 years to wait for my money to double. So understanding the rule helps you evaluate these banks. As we wrap this one up, I want to ask you, have you ever wondered how banks made their money? So it's important to understand what the bank's product. And the product is very simple. It's your money. The banks would take your money and they'll put it into what they call bank-owned life insurance. And it's the slide behind me. And you'll see that banks are putting the majority of their money in bank-owned life insurance. So then the question is, why? Well, they put it into these capital gains account, right? And what they do is they put that money in there, then they're able to take it out, borrow against it tax free. So now that money is going to be used for whatever ventures that the bank wants to do and have that liquid. And then it's able to actually go compound interest while it's still in the account. So the money's growing in two separate places at the same time. Why is that important? The law that actually covers and protects the banks and allows the banks to do this, and that's called fractional reserve banking. And banks are able to do that. They're able to take a portion of your money, almost all, 90% of your money, and reinvest it the way that they see fit. Now, how do they put your money to work for them? Oh, it's very simple. If you look at this slide, here we are, we the people, we take our hard-earned money and we put it into these banks. These banks then turn around and they'll put it in things like life insurance. They'll make other investments and things like that. But primarily, they'll take from Peter and pay Paul in the form of loans. And they'll loan out, right? A car, they'll loan out a home, they'll loan out credit cards, and then they'll turn around and give you a measly 0.5% or maybe 1%. With that being said, that's how banks make your money work for them. We now arrived at our second home of money, known as variable accounts, or commonly known as the stock market. Now, there are two major players for us here in the United States, and that's the S&P 500 and the NASDAQ. And for those that are unfamiliar with the S&P 500 and NASDAQ, it's very simple. The S&P 500 is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. It represents a broad picture of the overall U.S. economy and is considered a key indicator on how the stock market is doing. The NASDAQ is both a stock exchange and an index. The NASDAQ Composite Index tracks over 3,000 companies, primarily in the technology sector, such as Apple, Microsoft, and Amazon. It focuses more on tech and growth companies compared to the broader S&P 500. This domain can be complex, but offers significant potentials for earning money. But for those of you that have dabbled in it, you understand that it's a love-hate relationship. While you can make a substantial amount of gains, you can also experience a significant amount of losses if you're not careful. Aside from market volatility, another downside is the capital gains tax on the investment growth. Either you sell within a year and pay 25% on capital gains, or you wait past the year and you pay 15%. Additionally, management fees, often around 1%, can erode your returns. But don't get me wrong, the stock market is a great way to make money. But understand, the average percentage of stock market participants, such as fund managers and individual investors, who outperform the market over the long term is actually relatively low. Studies show that historically, only about 10 to 20% of active fund managers actually consistently beat the market, such as the S&P 500, over a multi-year period. According to the SPIVA, or the S&P Index versus Active Scorecard, over 80 to 90% of actively managed funds underperform their benchmark index over a 10 to 15-year horizon. Data like this suggests that most investors, especially those in actively managed mutual funds or hedge funds, have a hard time consistently outperforming market indexes due to factors such as fees, market timing, and stock selection challenges, which highlights its volatility and complexity. Even though it is a great way to make money, some people just don't have the time to learn the skills and knowledge to navigate the stock market like Warren Buffett does. Now, who is Warren Buffett? Warren Buffett is one of the most successful stock investors in the world, following a simple investment rule of don't lose money. And if you look at his portfolio, you'll see that approximately 60% of it is invested into the market. And that makes sense for somebody like him. But the remaining 40% is actually allocated towards index funds, which leads us to our final home of money. So before we move on, I want to ask you a quick question. Why does the world's most successful stock investor invest in anything other than the stock market? And now we've arrived at our final home of money called indexed accounts. And to answer the question from earlier, that's a two-part answer. The first part, I'm sure most of you have heard the phrase, don't put all of your eggs in one basket. And it's true. We shouldn't put everything or your entire future hinging off of one option or one lifeline. And then two, remember Warren Buffett's rule, don't lose money. And index accounts align with that principle by protecting your principal while allowing you to benefit from partial market gains. Why only a portion of the upside? Because these accounts are designed to minimize risk by having the company absorb the volatility. This means you capture market growth without the risk of losing money. When set up correctly, these accounts can do wonders and can be a valuable addition to any portfolio. Now, the index accounts that I'm referring to isn't index funds because those operate just like a 401k or an IRA, which means that it's tied directly to the market. An index account that I'm referring to is the ones such as index universal life policies or fixed indexed annuities. And those are tied to the market's performance and is based off of the market index like the S&P 500. So therefore, it's not directly tied into the market, it's just linked to it. Some of the benefits of linking your money to an index instead of putting it directly into the index is that it gives you growth potential, which means that your money grows based on the positive performance of a stock market index, giving you the chance to actually earn more than just traditional savings accounts and fixed accounts. It also provides principal protection, which means that your money's protected. So let's just say, for instance, you have $100,000 in a given account, and within those rolling 12 months, the market returned 7%. That means that your account will get credited $7,000 in total. Now, your next year, the market doesn't do so well, but now your new principal is locked in at that $107,000 instead of just that $100,000 that was originally in there. So that way, that following year, if the market does not turn out favorable for you, your principal will still be protected at 107,000 and it'll just grow like that for the life of the policy. In addition to principal protection, they also give you tax advantage growth. And what that means is that the money in your account is actually growing tax deferred. And of course, one of the biggest benefits of having an index account like this is that it gives you flexible access to cash. So what that means is that you're able to borrow against the money inside of your policy and utilize it. And that money, like I mentioned earlier, is growing in two places at one time. Now, of course, some of the downsides. And of course, I won't just give you the good without the bad. And some of the downsides to some of these products is that they have some of them have caps on their gains. In other words, they cap the amount that you can make, like I mentioned earlier, so the company can absorb the volatility, but in turn, they're protecting you from market downturns. Another thing that you need to be cognizant of when you're actually looking into these index accounts is what's called participation rates. And what participation rates are is how much money is being allocated towards a specific index overall growth. And when it comes to participation rates, you want to make sure that you're getting 100% participation in any account. And of course, one of the things you want to watch out for in index accounts is fees. Some of these companies out here offer these type of index accounts, but they're not the industry leading companies that are providing these products. And they normally bog down your overall cash return with administrative fees, policy fees, which can reduce your money. And then lastly, you want to make sure you're talking to a professional because these policies and these accounts can be very complex. And if you're dealing with somebody that doesn't know how to properly structure these things or don't even know the rules of the game, then they're not going to be able to properly strategize for you to make sure that the money that you're putting in there is going to grow and be advantageous for you. So now that you understand how money works, where people are putting their money, what's the best strategy for it? Well, Now we've come to the actionable portion of the video where we're going to help you get your financial home in order. So the first slide that I'm going to pull up for you is what they call the 50-30-20 plan. And what that means is based off of the amount of all the money coming into your household, how that money should be allocated. That way you have a strong financial home. And you take 50% of that money, okay, and you put it towards the needs of the house. You need to pay the mortgage, you need groceries, you need fuel for the car, you need to pay the car note, you need insurance, you need all that, okay? 50% of your money should be allocated to those things. 30% of your money should go to your wants. Right? You want to be able to take your family out to a nice dinner. You want to be able to go out to a nice dinner. Maybe go out to a movies, a beautiful park, concert, whatever it may be. That's all of your wants. And then 20% should always go towards your financial goal. Now, when it comes to your financial goal, that's everything. That's your retirement savings, that's your life insurance policy, that's your emergency money. All of that needs to be encompassed within that 20% of your money. Now, if you are finding that after your 50%, you're left with not much to allocate towards your 30 and 20%, then out of those three, the one you really need to start scrutinizing is your 30%. Because quite honestly, we can live without those 30%. That's just more for a luxury. And now brings us to our Secure 75 plan. Now, the Secure 75 plan was something that me and my team came up with after years of doing this business, and it's a basic strategy to kind of get you in the right direction on where to head and how to properly structure your portfolio to make sure you're capturing as much as possible. Now, the reason why it's called Secure 75 is because at any given moment, 75% of your money is always growing, and 75% of your money is always protected no matter what. Now, behind me is the slide that illustrates that. And you'll see here, it's kind of like a Venn diagram, okay? Where you have your structured money here, your safe money here. This is the money of your emergencies that you need. If you need access to within 24 hours of money, that's what's going to get put in this account. And this is going to be the one where you need at least 6 months of your expenses put aside so that way you can access it quickly. Now, 50%, which is the big one, 50% of your money should be going to principal protected vehicles. And that's more of like your fixed index annuities or your fixed accounts. That's like your CD accounts. That's your index style accounts and things like that, where it's going to protect your money when there's volatility in the market. And then lastly, 25% of your money should go towards the stock market. Why? Because that's honestly the best way to make money. Now, remember, you shouldn't put all of your eggs in one basket. So if you're younger, I would allocate more towards, securities because you have time to catch up. But the older you are, the less volatility you want to take, and you want to be more in with the protected principal vehicles. And this is quite honestly the best way to structure your money, where a good portion of it is always going to have some growth and a good portion of it's always going to be protected. So that way, at the end of the day, you're always winning. As we wrap up this video, I want to emphasize that many of these concepts can be complex, and the best approach depends on your unique goals. That's why it's crucial to continue to increase your financial literacy and take actions on the strategies we discuss. At MIM, we don't just introduce you to concepts and strategies. Whether you're just looking to enter the financial service industry or simply seeking more information on a specific topic, we provide you with unrestricted access to the information that matters most to you without any gatekeeping. To dive deeper into the products and services we touch on, we've shared a link to other videos where we break things down in more detail. So be sure to check those out if you're eager to learn more. And if you know somebody who could benefit from this information or is exploring new streams of income, especially in the financial service industry, please share this video with them. And if anything we discuss resonates with you or sparks any interest or curiosity, don't hesitate to reach out through our website at mim.life. And take control of your finances today so that way you can have a better tomorrow.